Most traders think MACD is about crossovers. They wait for the lines to cross, enter late, and then wonder why the move is already over. But what if I told you the real power of the MACD happens before the crossover? Today, we're breaking down whether the MACD still works in today's market, and how professional traders use it to read market momentum shifts early and not late. This is episode 4 of our series, What Works in Today's Markets, where we break down the most popular trading indicators and test whether they still give traders an edge. We've already covered moving averages, RSI, and VWAP. Now it's time to talk about one of the most misunderstood indicators in trading, the MACD. Now, before we get started, this video is for educational purposes only. I am not a financial advisor, and you should definitely trade at your own risk. Now, what is the MACD? MACD stands for Moving Average Convergence Divergence. At its core, MACD measures the relationship between a fast and slow moving average, which means it's really measuring momentum, not direction. When momentum is increasing, MACD expands. When momentum slows, MACD contracts. That's it, no magic. The biggest mistake traders make is using MACD crossovers as entry signals. By the time the line crosses, momentum is already shifted. MACD doesn't lead price. It confirms what's already happening. If you wait for the crossover, you're reacting, not anticipating. Now let's go into how pro traders actually use the MACD. 1. Momentum, expansion, and contraction. Professional traders focus on the histogram, not the crossover. When the histogram starts getting smaller, even while price keeps pushing, that's momentum slowing. You'll see this all the time. Price makes a push, MACD histogram fails to expand, market pauses, pulls back, or reverses. 2. MACD divergence. One of the most reliable MACD signals is divergence. If price makes a higher high, but MACD makes a lower high, momentum is weakening. Same logic for bullish divergence at lows. This isn't rare. You can find this on almost any liquid market almost every week. 3. Zero line context. The MACD zero line acts like a momentum bias filter. Above zero means bullish momentum environment. Below zero means bearish momentum environment. Instead of trading every signal, pros ask, is MACD expanding with the bias or fighting it? The MACD works best when the market is trending, momentum is shifting their structure, and is used as a confirmation, not a trigger. The MACD fails in choppy markets, if you trade crossovers blindly, and you ignore key things like structure, VWAP, and volume. So does the MACD still work in today's market? The answer is yes, but not as a buy or sell indicator. It works as a momentum diagnostics tool. When you combine MACD with market structure, VWAP, and RSI, it helps you spot weakness before price reacts, not after. The MACD isn't outdated, it's just misunderstood. Stop waiting for crossovers and start reading momentum. In the next episode of What Works in Today's Market, we're breaking down the Fibonacci, one of the most controversial tools in trading. Some traders swear by Fibonacci levels. Others say they are completely meaningless. But here's the truth. Price doesn't react to Fibonacci because of magic. It reacts because traders and algorithms are all watching the same levels. So next time we're answering one question. Do Fibonacci levels actually work? Or are they just lines that traders convince themselves to believe in? Now, if this breakdown helped you see MACD differently, make sure to like the video and subscribe for the next episode in the series. And leave down in the comments, do you use the MACD? This is X Viper TV. Thanks for watching and happy trading.